participants to me.
Yeah, there's some other ones which the numbers you don't see.
Okay,
Yeah.
great.
Okay, so easier.
Sanjay sir, namaskar.
Namaskar, namaskar. How are you? Sorry,
Your
I'm
blessings.
yeah, I have to go to in a marriage and huge traffic. That is why
Yes.
I have not been able to join you
If we can
today.
use metro, it will be better, sir. Yesterday also I attended one marriage and road pe absolutely chaos hai.
Metro, boss. The thing is this: either it should be near. Now we people are not tuned in to travel, walking, etc. So we have very less participation today.
Okay.
Nevertheless, because we put everything on YouTube
Sure.
and later on views comes, it might be possible today being the Saturday and the but we sent all mailer etc. everywhere. Might be the topic like this, but nevertheless, numbers are not important. The important is this that what deliberation we are taking or we are giving to the members. When I started, I tell you, Sundarji, that when I started my
Sir,
career,
आप मुझे पुष्पेंद्र बोलिए sir.
when I started my career, there was a seminar which I attended, Trans Jamna. So there were 5 participants only. But let me tell you, those who have missed, they missed that participation at that time. And then thereafter, the same topic, next week I spoke in the same place. So a lot of appreciation came. So let me welcome you formally in this seminar. And I think, Rishabh, you have made the introduction, etc., the formal part.
No. You give your opening address, then I'll introduce him.
Okay.
And then we'll move ahead.
So, friends, I welcome you all, especially the speaker of the day, Pushpinder ji, and both son and son-in-law on the screens, Rishabh, CA Rishabh, and CA Vishal Thapa ji. Today, this complex world of taxation of digital economy is gaining a lot of importance, and a lot of issues are emerging out of this particular taxation of this digital. The recipient is where, service is somewhere else. People are using some of the platforms where the money are being taken, and the recipient or the service providers, they are not known at all. So that has gained a lot of importance. Then the big data. Somebody collects the data. For example, I was attending the IFA year before. So in IFA, we were discussing at that time that, look, if suppose in a machinery, there is a sensor which is being installed, and that sensor takes out the data of that machine running, and then data is transferred to the machine supplier. Machine supplier is given the contract to someone third one who's a related party, may not be related party, and then data is being collected, and data is not only used for setting up the you can say faults in the machinery, but the data is collected for the purpose of knowing the wear and tear, atmosphere, lot of research which is used in that data, and who is in caching at what time, and where is the inventory is of those digital things. So these are the few things which are in the complex world is being discussed. So the digital economy is a big word, and today being a lot of you can say mode of payment I've been hearing day before yesterday that in Middle East, even the UPI payment is going to start. So all of these issues, I think we are trying to cover in this particular webinar. And the main thing which might have triggered that less number of participants, because this is a webinar we have specially crafted for industry, and we are trying to get the industry speakers, and industry speaker are speaking on some industry topics or the topic which are of immense importance. So this might be the reason, because we have not circulated among most of the you can say practicing chartered accountant. So with this, Rishabh, back to you.
Thank you. And as he was mentioning, we have started this new initiative of bringing in industry experts who are actually, you know, uh, trying to bring in more industry-specific issues or certain general issues which are, uh, let's say, important across industries, not just in one of them. And that's what is today's topic about. So, taxation of digital economy, or digital taxation as we've called. So participants, we have CA Pushpender Dikshit with us, and I'll give a very brief introduction from his formal profile. So currently, he's the Vice President, Global Tax Head of PVR Inox. So anyone who wants something on PVR and who is a movie fan can drop him an email. I saw his email on the front slide, the title slide as well. So yeah, so he's a vice president, global tax head of PVR Inox. In terms of his qualifications, he's a chartered accountant. He's he has his masters of law in cyber law. So now you know from where this inclination towards this topic is coming in. He's someone with the more than 18 years of experience, and I haven't seen who a professional who is dealing with all facets of taxation, including direct taxation, international tax, transfer pricing, indirect tax. Now GST. So he has been, working across industries, from Dell to Ericsson to Mentor Graphics, NIIT, and now finally PVR Inox. So, sir, that's a small intro of CA Pushpender Dikshit. He'll be taking us through the nuances of digital taxation, the provisions that are there, the issues that are there, why and hows of it. And sir, over to you. We will be here to hear out your thoughts, and a small instruction on the for the participants. After some time, maybe about 45 minutes, we'll have a small 5 or 10 minute Q&A, so that whatever questions are there till that point of time are cleared out. So you can put your question and answers in the Q&A section, and we can take them during the relevant points where Pushpendra sir would stop us, and we'll take a break for the Q&A. Sir, over to you.
Thank you, Sanjay sir, and thanks Rishabh for the introduction and setting the tone, Sanjay sir. Uh, Sanjay sir rightly mentioned that digital economy is the buzzword, and today, as we speak, we are on the crossroad of how to fix taxation of digital economy. Virtually all the things which we do, like goods, services, personal, commercial things, moved. I think 70+% of the transactions are being moved to digital channel, and it is of immense importance for us to understand and fix those open points. Although there are some unilateral measures which government across the globe have taken, and India is pioneer among them, it has taken certain steps which we'll talk about as we proceed in our slides. But the point is that we are just trying to touch upon the issue, the actions taken so far, and the possible course of action to fix this digital economy, because it's a very wide and comprehensive topic affecting each one of us. So let's, without much ado, let's quickly delve into it. I'll just put up my slides, Rishabh. Is my slide visible, Rishabh?
Yes, sir.
Okay, great. Just a minute. I think it's not moving that way. Let me do it once again. Sorry, the entire screen. Yeah, it's visible, right?
Yes, yes, and it's moving.
Yeah, great. So, friends, let's talk about the existing taxation quickly, because we have had almost a century old tax principles, and which are still going on. While we are trying to find answers to digital economy taxation, there are already mature tax principles and there are already open tax challenges also. So, this particular slide, I have tried to capture few of them. Ongoing tug of war. This is, I am talking about non-digital economy or the current economy. Ongoing tug of war between source-based and residence-based taxation is still going on between developed nations and developing nations. While developing nations always stressed upon source-based taxation, and developed countries represented through OECD mostly, they have been always speaking about residence-based taxation. Evolution of the concept of business connection as per Section 9 of the Income Tax Act, which started with the physical presence and evolved to the extent that actual services should be rendered regardless of whether in India or outside India, as long as the service beneficiary is in India, income gets accrued in India. So that much journey we have already traveled as per the existing tax principle, and it has been very well captured in Section 9 of the Domestic Income Tax Act. Definition of royalty and business connection in Income Tax Act and double taxation avoidance agreement, which India has entered into with various countries. There are some restrictions in terms of the definition of royalty and permanent establishment, qua business connection in the tax treaties, whereas Domestic Income Tax Act has a comprehensive and wide definition of royalty and business connection. So we'll talk about it. Permanent establishment is a very important concept, we all know, and it is a gateway to tax a non-resident business income in the home country. How a business gets a permanent establishment in India, what kind of P it is it a branch P, agency P, service P? These all are existing concepts and we deal with them in our normal course of business day in, day out. Very recently, the concept of copyright versus copy of copyrighted article has also been talked about. While domestic tax law always tries to capture even copy of a copyrighted article under the category of royalty, nonetheless, the tax treaties of different countries, including United States, UK, they are having restricted definition of copyright. As per the treaty, a copy of a copyrighted article is not considered as a software. So this fact has also got affirmed by the Honorable Supreme Court of India in the case of Messrs Engineering Analysis Center of Excellence Private Limited. We'll talk about it as we proceed. But idea was just to touch upon few open points, like we've been learning all these concepts and we have been dealing with these concepts, and now we have to face the digital economy. Last on the point is taxation of passive incomes through deeming fiction. So all across the globe, there is a parity or common understanding for taxation of passive incomes, which are being taxed in the form of tax withholding on gross basis, any dividend income, royalty or fee for technical services, interest for that matter. If it gets accrued in India, then Indian government will apply TDS, and the recipient country will obviously be aligned with it because they know it's a passive and deeming fiction, regardless of the fact whether the company in which investment has happened is in India or the royalty, etc. As long as it is earned from India, Indian government will apply TDS to that, and the other country will obviously take the credit of it. So these are the existing understanding and the open challenges which we have to deal with. Now, let's enter into the new world of digital economy. Rishabh, I think there is an issue. It does not move every time. I'll have to. Is it okay if I go like that? No.
Yes, sir. You see, when you will go to off screen, you have to
Yeah.
again share it, and
Okay.
then you have to start.
Okay. So is it visible or again I need to share?
No, no, you need to share, sir. I think when you are speaking for a long time, it will not. I think you have to click and
Oh,
switch. It will
okay.
not go from the
Okay.
keyboard
I
probably.
I got it. Sanjay sir mentioned rightly. I think I'll have to do it every time I have to switch the. No worries. I'll just quickly do it.
You can just share the screen once and
Yeah.
yeah. So yeah,
Okay.
I think you have to use the mouse, sir. Once you speak for a while, it gets
Understood.
inactive.
Sure. Understood.
So you can
So
just
friends,
click to
let
go to the next slide.
yeah. Okay. So, friends, now we are talking about the concept of significant economic presence, which is a very new concept introduced in the Domestic Income Tax Act, Section 9, and which is a very comprehensive concept, which is, a step up to existing permanent establishment definition or a business connection, which was earlier standing. So let's understand this business significant economic presence. And this significant economic presence was a concept which was contemplated just to make sure digital economy is pervasive now, and most of the transactions are switching to digital economy. So significant economic presence provisions in the Income Tax Act have significantly widened the scope for the term business connection. It is applicable from the financial year 21-22, although it was introduced in 2018, but it was deferred for some time because there was a lack of consensus in terms of the taxation. So Indian government was also mulling over that maybe by 2020 or so we'll reach some consensus globally also, then this concept will work. But since we are yet to reach the consensus about the taxation of digital economy globally, Indian government introduced SEP provisions and made effective from 2021-22 FY AY 22-23. As per SEP provisions, a non-resident forming SEP in India shall be deemed to have a business connection in India and would be liable to tax irrespective of whether agreement for such transaction or activity is entered in India, or a non-resident has a residence or place of business in India, or non-resident renders services in India. So, irrespective of all three conditions, a business specific economic presence or a business connection will trigger in. Explanation 2A to Section 9. As per this provision, a non-resident shall be deemed to have an income accrue or arise in India if SEP is established in India. What is the threshold for establishing SEP? Let us understand. The aggregate of payments arising from transactions in respect of any goods, services, or property carried out by a non-resident with any person in India, including provisioning of download of data or software in India during the financial year, if the transaction exceeds 20 million rupees or rupees 2 crore during a financial year, or it is not and it is or a non-resident undertakes systematic and continuous soliciting of business activities or engages in interaction with 300,000 or more number of users in India. So friends, this particular threshold is very wide, and it is or either 2 crore rupees threshold or dealing with you know 300,000 or more users in India. Either way, your SCP gets triggered in India. We'll talk about more once we deal into a specific situation. Let me move to the next slide.
Again, you have to share.
Yes, sir, I'm just doing that.
Sir, you can. It is not necessary to reshare again, sir. You can just click on the slides. It will move. You will click on the slide. It will move, sir.
If there is a time lag, then it gets static, I think.
No, no, but you have. If you will click, sir, then it will move even
Okay.
after the time.
Sure, let me try this time. Sorry for this, uh, gap. So I was just talking about setting the tone for SCP concept, and we talked about the threshold, either 2 crore rupees value of goods, services, properties, or systematic and continuous soliciting of business with the threshold of 300,000 users or more. In addition to this, it has also been clarified that income attributable to the operations carried out in India will also include that advertisement that targets Indian customers. So it's very comprehensive concept. Just try to imagine that SCP also includes income from advertisement that targets Indian customers. So it's, I mean, while we read, we'll try to understand, but we'll also try to think about how practically that will be, operationalized. How will you, figure it out that advertisement that targets Indian customers, sale of data collected from India, or sale of goods and services using such data collected from India. So very comprehensive, friends. The SCP provisions were introduced in 2008 that we talked about. So let's move to the new. Now it's working, I think. Yeah. So SCP provision we talked about, and let's also try to understand what Indian government has undertaken in Domestic Income Tax Act to capture the digital economy transactions. We just spoke in the last slide that there was a lack of consensus. Globally, countries are still mulling over how to capture the digital economy transactions because no country can afford to miss the income of digital economy transactions in their home country. But whether same line of approach to characterize a particular income, business income, oblique royalty income, or oblique passive income, we need to have a consensus on the treatment or characterization of income. That is yet to be done. Now, during the work in progress, how Indian government has done it, we'll talk about it. The CBDT set up a committee of taxation of e-commerce to evaluate the taxation of digital economy, and it was recommended that equalization levy as a viable option as it did not require alteration in the existing tax treaties, and it became one of the first countries. India became one of the first countries to levy equalization levy, which was also popularly known then like Google tax, at the rate of 6% on the online advertisement. It started in 2016 and it got further widened in 2020 by including sale of goods and services as well. So certain measures which India has taken unilaterally to tax digital economy, I have enumerated. First, we just spoke about it, equalization levy. That is a tax on online advertisement, provision of digital advertisement by a non-resident to Indian company or Indian person who does not have a presence in India. In that case, the Indian user will have to pay 6% tax on that online advertisement and pay it to the government of India. Equalization levy is not part of Income Tax Act. It was part of the Finance Act 1994 and it was introduced in 2016. Another important point was SEP presence, which we spoke in detail. Equalization levy 2.0, which is actually advanced version, while equalization levy 6% was specifically to tax online advertisement by non-resident in India, in Indian company or Indian users. Equalization levy 2.0 is basically targeted to non-resident supplier of goods or services to India, and 2% tax on that will be payable by the non-resident in India. There were certain withholding tax provisions also which got introduced in Income Tax Act in the form of 194O, 1% tax on by e-commerce platform, and also very recently 194S, which was 1% for virtual, VDA, virtual uh, digital assets, that was also introduced. For the purpose of completing the whole circle, I also included 2 points, point number 5 and point number 6, which are not direct tax, which are related to indirect tax. But idea was just to give you a perspective that not only under income tax law, but in GST also, Government of India has included deeming provisions and targeted non-resident who are providing online information, data access and retrieval. For example, online musics, online software, etc. So even those non-residents are under an obligation to take registration in India, file return in India, and pay GST in India. Section 52 of GST Act talks about TCS by the e-commerce operator. So these all are the unilateral measures which the government of India has taken to make sure a non-resident who does not have a presence in India, who does not have a registration in India, but earns income by selling goods or providing services in India should pay due tax in India. TDS on e-commerce transactions that I briefly talked about. So basically, first time it was introduced in October 2020, and very much used these days in the industry. In our business also, a lot of online booking of tickets, foods is being done, and those e-commerce operator, aggregator, they apply 194O and pay us after applying the tax 1%. E-commerce participant, they have defined a person, a resident in India selling goods or providing services or both, including digital products through digital or electronic facility, platform for electronic commerce. They also talked about that if TDS rate will be doubled or will be 5% if PAN is not available. No TDS deduction under 194O if TDS is deducted under any other section. So obviously there will not be duplication. No threshold limit for corporate e-commerce participant, but for individual an HUF of up to 5 lakhs. So an individual HUF who does not have a turnover exceeding 5 lakhs has a exemption, not to have 194O applicable on them. For corporate, it is applicable without any threshold. Yeah. So entry of equalization levy. While there is a belief and there is also a debate that once there is a consensus about the characterization and taxation of digital economy transactions, once OECD Pillar 2 approach sees light of the day and it gets incorporated into domestic tax laws of the countries, these unilateral measures, for example, the equalization levy 1, which is basically on sale of advertisement, or equalization levy 2, which is basically e-commerce supply of non-resident to Indian consumers, will go away. But we'll see whether or not it goes away. But this is the understanding as of now. Equalization levy 6 and 2%, which we talked about and will pick up for any question, but certain important points which worth repetition here are: equalization levy is outside the ambit of Income Tax Act, and therefore the DTAA applicability has a limitation in that. What do I mean by that? Generally, tax paid under income tax law is covered in the tax treaty also. But since equalization levy is not part of Income Tax Act but part of the Finance Act, uh, the credit in the foreign country of that is a question. TDS under Section 195 not applicable on payments covered by EL. So it has to be mutually exclusive. If you have applied TDS under Section 195 as a non-resident transaction, then you don't need to apply equalization levy on the same transaction, and it has got clarified through the exemption under Section 10 subsection 50. In case a non-resident e-commerce operator has a PE in India, then normal domestic IT provisions and relevant DTAA will prevail. So, mind you, equalization levy is applicable only when a non-resident does not have a PE in India. The moment he has a PE in India, then we have to uh, look into the PE provisions. We have to tax the income which is attributable to source country, which is India in our discussion, and they have to pay tax on the net basis, not on the gross basis. Yeah, last is a important point. Liability to pay equalization levy of 2% is on the non-resident e-commerce operator, whereas equalization levy of 6% on supply of online advertisement is applicable on the payer, which is an Indian user, and he has to deduct that 6% and pay it to the government. So let's understand the scope and exception a little more in detail. Equalization levy normally applies to online supply of goods or online provision of services to persons resident in India, but may also apply to non-resident in the following circumstances. So let us understand when a non-resident also gets triggered to equalization levy. For sale of advertisement targeting a customer resident in India or a person who accesses the advertisement from an IP address located in India. Sale of data collected from a person who is resident in India or a person who uses an IP address located in India. Third, person who buys goods or services or both using an IP address located in India. So these are the situations in which equalization levy will apply. Where exceptions, we let us understand the exceptions. Where e-commerce operator has a P in India, we just spoke in the last slide. अगर P India में बन जाता है, then equalization levy will not apply. We'll have to deal with the business connection concept or the permanent establishment concept, and net income पे टैक्स लगाना पड़ेगा. Gross basis पे टैक्स नहीं चलेगा. EL at the rate 6% applies with a threshold of 1 lakh, whereas there is no threshold then 2 points. I mean, there is a threshold of no, no, so my bad. Equalization levy of 6% on sale of online advertisement. It has a threshold of 1 lakh rupees, whereas equalization levy 2.0, which is applicable 2% on sale of goods and services, it also has a threshold of 2 crore rupees. But in either situation, equalization levy, one equalization levy will apply. They will not be like both equalization levy on the same transaction. They are mutually exclusive. So maybe Rishabh would be a good idea. Like I will deal with pillar one, pillar two, but would be a good idea if you can check with the participants about any question that we can pick up and we can deal with, because pillar one, pillar two I'll deal with later.
Sure. So participants, if you have any questions regarding right now, on the overall context, the SEP provisions or the intention of bringing SEP and, the unilateral measures that we were talking about. So if there are any questions on those, please put in the chat box. And sir, apart from the participant, I have my own questions uh,
Great,
from your deliberation right now.
sure,
So I'll until the participants put their questions in the chat or the Q&A, I'll ask one of my personal questions here.
sure. Go
So,
ahead.
sir, for SEP, when we read uh, this definition of when an SEP is established,
Yeah.
so in those scenarios, I mean, we are trying to target digital businesses, we are trying to target the digital economy, but the definition is quite open. So how to go about it? What do you think? I mean, in terms of the practical enforcement or applicability, does it go beyond uh, the actual intention, or what was the intention to bring in the SEB provisions, and but then the definition was way beyond digital businesses. So, what is your opinion? I know there cannot be nothing. There could be nothing, right or wrong. We can just have opinions, agree and disagree, because law is law at the end.
No, no, it's very good question. And I completely second your thought about the comprehensive definition of significant economic presence. So we'll just take a step back to understand the background of this legislation or this particular amendment. Is that while we are trying to reach a common consensus about taxation of digital economy, we have had BEPS measure, base erosionment and profit shifting, with 15 action plans in 2015. And one of the first plan was, how to tax digital economy. Somehow those BEPS action plan 1 did not fructify the way it was contemplated, and OECD was at the helm of it, and they thought maybe in BEPS 2.0 they tried to capture this OECD two pillar approach. But at that point in time also, while they were trying to reach consensus, they suggested till the time there is a common consensus about taxability of digital economy, we should have certain measures to make sure that tax leakage which is occurring in digital economy environment should be tapped to the extent possible. So those measures, OECD itself, suggested one of the following. One was SEP, one was tax withholding, and another was equalization levy. It suggested one of these. Nonetheless, Indian government was like smart enough; they picked up all. They legislated one by one all of these in their domestic law, and I agree. Idea was just to make sure no room is left for any tax evasion or any tax leakage. It has been defined in a very comprehensive manner without clear cut understanding of how practically you will try to slice and dice. For example, systematic and continuous. For example, either or. So those are certain areas which need to be tackled as we progress ahead in our practical world. But I agree, right now the definition is very comprehensive and needs clarity.
Yeah. I think that squarely covers your view. We have a couple of questions from the participants. I'll read them
Yeah.
out to you. Though it
Mhm.
looks like a personal case, so just make sure it is on the academic front and not a advisory. So
Yeah, yeah, that disclaimer you can give.
yeah, so
Absolutely. Please
we'll go
contact
on.
qualified professionals for professional advice. But yes, we can give indicative answers.
So the question is that Indian resident has purchased from non-resident cloud advertisement,
Mhm.
and then it's selling either to a resident or a non-resident. I mean, it's a trader, basically a reseller. So how will it work with either SCP or EL and the interplay?
So let's first understand in a normal scenario. That is a business as usual situation in normal IT companies. A lot of online tools and software, etc. They are subscribed, and people are still not very much familiar with equalization levy concept. So we also advise them, if you have any doubt or lack of clarity about equalization levy, etc. Although it is clarified that it is applicable on online advertisement by a non-resident. For example, a Singapore-based company which is non-resident in India, doesn't have a PE in India, does some advertisement work for you. So you have to apply 6% equalization levy while remitting money to them. This is a plain simple definition. Nonetheless, many a time there is a very thin definition. You will appreciate, Rishabh, that whether it is an equalization levy or whether it is FTS. Correct. The moment you call, because characteristics of FTS also includes technical payment, etc. If you are categorizing it, if it is tilting more towards FTS, you can apply 195 instead of going in for equalization levy, and take the benefit of allow the benefit of that tax credit to the other party in the home country, because equalization levy, I doubt whether they will be able to avail or not.
Yeah, that is also one of the bigger concerns, and you rightly mentioned it as an exception in your slides also, that
Yeah.
as it was introduced to the Finance Act, not in the Income Tax Act,
Yeah.
uh, how, I mean, there are certain doubts on the interplay of taking treaty benefit with
Correct.
respect to application of equalization levy.
Yeah.
So I think that covers, this was a interesting question that we have. then I think we can proceed with the deliberation.
Great. So I have like a pillar one, pillar two discussion. Let's proceed with that discussion.
So you'll have to, you just unshared your screen. It was already there. Yeah,
Okay.
perfect.
Yeah. Okay. So friends, the next big talk of the town is uh, pillar two approach by OECD. I just
Correct.
want to talk about quickly background of it. The OECD is Organization for Economic Cooperation and Development, and
Sir,
an
sorry to
organization.
interrupt, sir. It's not on full screen right now.
Oh, stop sharing. Let me try once again. This,
Yes, 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 yes.
is it
Perfect.
okay?
Yes, right, sir.
Great. So, Rishabh, I was just mentioning for the benefit of listeners and participants that OECD is an organization which is tasked with the responsibility of fair taxation of international transactions. And it came up with BEPS, base erosionment and profit shifting, 15 action plans. Somehow those action plans did not work well. Few actually worked, few set the tone for pillar 1, pillar 2 also. But the main question before OECD was to find a solution, a viable solution for taxing digital economy. And pillar 1, pillar 2 is basically somewhere tries to address that. Although OECD pillar 2, pillar 1, pillar 2 solution applies on related party transactions, but then tax evasion and tax goof up is occurring basically for related transactions. Unrelated party generally do not have any motivation to make any alteration into the normal business transactions. So we'll try to understand global balancing act, which is being uh, done by OECD, G20 countries, and India is obviously taking very active part into it. And India will set the tone because India is now two-way helpful to the globe. A, it has the highest consumer base. B, it has the best of the brains. So India is either way inevitable to the globe. They have to take India along, and India has to play a pivotal role. So, friends, let's try to understand in brief. Although the concept of two pillar is little technical, and it is not yet seen light of the day because it needs to be included into the domestic act. It needs to be included into the tax treaty through MNEs. So, multilateral instruments, MLIs. But I'll try to make it simple and easy to understand for the participants that these are the two pillars which are trying to make sure number one, that income is being taxed globally on the basis of accrual. Wherever income is earned or accrues, tax has to be paid at that jurisdiction. And this is the concept which we have been, India has been advocating since so many years, that taxation of income should be on the accrual basis, source basis. Now, finally, all the countries and OECD as a body, they have agreed to that concept. Although threshold is higher, we'll talk about it as we'll go into steps. But just to set the tone, that source-based taxation has been accepted by the OECD and G20 countries, which was typically was the ask from the developing countries represented by the United Nations Model Tax Convention. And the second pillar obviously talks about the minimum taxes. Regardless of the place where you operate, 15% tax आपको देना है. Although in both the pillars, threshold has been kept little higher. Threshold will obviously settle down as we proceed into these two pillar approach. But what is important and what I want to accentuate is that the principle has been accepted, that taxation of source country or source market has the right to tax the income which is sourced from that particular location. And regardless of the place where you are headquartered, regardless of the place where you operate, 15% tax you have to pay. So let's understand one by one. I'll talk first pillar one, which talks about the reallocation of taxing rights. So pillar 1 focuses on fair allocation of profits and taxing rights among countries, i.e. home country and user country having nexus. Multilateral multinational enterprise in scope. So global turnover of above euro 20 billion is what they have right now set. So pillar 1 will trigger or apply only when the global turnover of multinational enterprise is above euro 20 billion. It is expected that this higher threshold will get reduced to euro 10 billion after 7 years of pillar 1 implementation, effective implementation. So we'll see, but as we speak, it is kept at euro 20 billion. Second, 25% of the residual or non-routine profit above the 10% of routine profits. So how much allocation is done is 25% of the residual or non-routine profits. So an organization which is having a profitability above 10%. So that above 10% will have to see how much is the value, and then 25% of that will be considered for the purpose of reallocation of taxing rights. Pillar 1 has two important amounts, amount A and amount B, which is also known as adjustment. So pillar A, amount A talks that income of M&E deemed residual profits to market jurisdiction using formulaic revenue based approach. So which I just spoke about in previous discussion, that in case uh, profit of that M&E exceeds 10%, then excess of 10%, 25% of that will be considered as amount A, and amount B is basically for marketing and distribution functions. For example, a non-resident company, which is in overseas, and it is doing some sales and marketing distribution function in that jurisdiction. So you have to give sales and marketing distribution returns based on arm length principle of transfer pricing. So if we put these two amounts together, amount A, amount B, then it talks about that fair allocation of tax to the market jurisdiction will be completed. So pillar 1 basically seeks to apply tax certainty through a effective dispute prevention and resolution approach, that tax is linked to the source. Coming to pillar 2 is basically minimum tax. Gone are the days that multinational organizations or multinational enterprises will scout for a low tax or no tax or tax haven jurisdictions. Now we have to pay tax, and we have to pay minimum tax regardless of the place where you operate. Pillar 2 requires MNEs with an annual turnover exceeding 750 euro million to pay at least 15% tax. Generally, country like India, which has 25%, 22 plus surcharge, I think bare minimum tax is 15 or above. For some new manufacturing companies, we have introduced 15% taxation, but there is no tax below 15%. So practically, pillar 2 will not apply for inbound companies in India, because India always has 15% plus tax. It will be the case for outbound, an Indian headquartered company operating in Cyprus, operating in Ireland, where tax rate is 12.5 or less than 10%. There will be the case of catching up with pillar 2. So pillar 2 basically consists of four globe rules: income inclusion rule, undertaxed payment rule, subject to tax rule, and switchover rule. So basically, globe rules are basically contemplated how to make sure that the company which is operating in a low tax or no tax jurisdiction end up paying 15% tax. These are the four safeguards through which we will try to capture 15% minimum tax. We'll understand how one of these can be applied. IRR and UTPR are to be included in the domestic act. For example, income inclusion rule and undertaxed payment rule. These will be incorporated into the income tax act in one way or the other. So we were expecting it to be included by this budget, But let's see what development takes place in the full-fledged budget, because we had this interim budget. Hardly there was any tax, amendment. But we'll look forward to have some amendment in this regard in the budget somewhere, July. Let's see. STTR and SOR, subject to tax rule and switchover rule, are basically treaty concepts. Will be included in the double taxation avoidance agreement with the help of MLI. It is important to note that globe rules do not compel any country to adopt a minimum tax rate. You don't need to incorporate a minimum tax rate, but if source country does not levy a minimum tax, then the other jurisdiction would have right to tax. So while globe rules do not force a country that your minimum tax rate in the corporate tax rate should be 15%. You may say you have 10% corporate tax rate, but the other country which is adopting pillar 2 approach will have to legislate in their domestic act some principle like these IRR, UTPR, STTR, etc., to make sure that the source country gets 15% tax, or maybe headquartered country have to pay tax, but it has to be made sure 15% tax is paid by that country. So it will help in avoiding double taxation and levy of tax where there is a source of economic profits. So basically, in whether we are talking about the non-digital economy or a digital economy, tax fundamentals would remain the same to my mind. What we need to understand is the underlying business model, where income is accruing, what is the source where benefit is passed on, who is the service provider, who is the service recipient, what is the underlying goods or service. If we are able to slice and dice these things, we have century old tax principles to easily ascertain the tax liability on net basis or gross basis that we will see. But digital economy, people are little unsure about the source and about the seller or the buyer or the user, because these things are not crystal clear. Although through blockchain technology and other technology help, we can get the every required detail. But as we speak, that is an area work in progress. Some important thresholds. I mentioned about the fact that two pillar approach for the first time have accepted the concept of India like source based taxation, but thresholds are way high. To apply market nexus rule to allocate income in respect of a particular market jurisdiction, the concerned multinational enterprise should derive at least 1 million euros in revenue from that jurisdiction. Again, a very high threshold. Country like India or others may not agree to it. But what I was mentioning is, look at the principle. At least they have accepted that source-based taxation. That 1 million euro could be, reduced to 1 million INR also in future. For smaller jurisdictions with gross domestic product lower than 40 billion euro, nexus will be set at euro 250,000. Countries are free to apply income inclusion rule to multinational enterprises headquartered in their country, even if they do not meet the threshold, except some exempted organizations. So basically, regulated financial services, non-profit organizations, government entities, they'll be out of it because they hardly do any, hanky-panky things. So they have included them that it will not be part of the threshold. They have got them an exemption. Yeah. So pillar two concept little more in detail to set the tone and to also let you connect with these concepts. Although again, I reiterate that these are the fairly new concepts. Until we practice these concepts in our day-to-day corporate or practice, we will not be very much familiar. But it is always good to understand the new concept and also appreciate the underlying reasoning why these things have come up. It will help you to catch up the amendments once it takes place in the domestic act as well as in the underlying tax treaty, and you will quickly able to connect and correlate. So basically pillar 2 stands on the with the support of four interconnected rules. which are also known as GLOBE rules. First is income inclusion rule. This is similar to CFC. So basically, controlled financial corporation rule imposes additional top-up tax on a parent entity if constituent entity is in low tax jurisdiction. So your income inclusion rule will be part of your domestic act. For example, hypothetically, Indian government amends Income Tax Act, includes in Section 9 something like that. If a company which is headquartered in India operates in Cayman Island, it does not get that 15% bare minimum. Then obviously, it will have to pay more tax here in India, or vice versa. Generally, outbound cases will be applicable here, Rishabh, because India anyways has 15% or more tax rate. Um, Another is under tax payment rules, UTPR. So if IRR is included, then UTPR is not required. UTPR is basically a fallback rule when particular a parent entity jurisdiction does not apply IRR. If IRR is not in the domestic law, then UTPR is a fallback rule which would deny certain deductions or make some adjustments so that your tax liability becomes equal to 15%. Again, let's try to understand the concept. We'll see how it sees light of the day, which formulas and all those things, but idea is clear. Either the home country has legislated the act and takes the top up tax, else the source country will have to pay, or the source country will not get certain deductions of the uh, some transactions between the parent and subsidiary company, making sure that the tax liability gets to 15%. Third is STTR, subject to tax rule. So basically, incremental tax withholding applied if recipient is taxed at a lower than triggered rate. Again, the foreign jurisdiction, if it is receiving some payments from an Indian company and that particular country does not have a tax rate 15% or more, then by inflating the tax withholding rate, they'll try to meet that objective. Switchover rule is contemplated to help resolve the conflict between domestic provisions and tax treaty provisions. So I just mentioned that IRR and UTPR, they are part of the domestic. They will become the part of domestic tax laws. But STTR is basically a DTAA concept, and switchover rule is basically to make sure if there is some dispute or some confusion between IRR and STTR, it will try to resolve through DTAA mechanism. Um, it is important to note that IRR and UTPR are interlocking rules, and they will be in the part of domestic act that I spoke about it, and STTR and SOR is part of tax treaty. So, Rishabh, we can take questions. Then I have a last slide.
Sir, we have only one question right now, which is still relating to EL.
No
Um,
worries.
if you want, I can take it
Yeah,
up.
yeah, please, please, please.
So the question precisely is whether posting jobs on Facebook or Google, etc., comes under the ambit of EL. Is it kind of advertisement as included in EL?
So, which Facebook? Is it Facebook India or Facebook Singapore or Facebook US?
The details are not there, sir. Please answer for
So
all the categories.
let us assume that it is Facebook US, which
Hmm.
does not have a PE in India, a non-resident company, and Indian company is using their portal to advertise job, etc. Right? Generally, LinkedIn Singapore is common example, but let's go with this. So in that case, equalization levy will apply because it's an online advertisement by an Indian company with the help of a non-resident through online mode.
Okay.
Yeah.
So no more questions on the board, and I think the attendee who asked this question has already responded. It's very clear. Please, you can move ahead, sir.
All right. So we're not getting much questions. Either people are not, or maybe the concept is little this, but no problem. I recall Sanjay sir's first experience. The concept is such that people will, understand and come up with more and more queries, and they'll try to relate it with their business. So
No,
then we'll
no.
see.
People will come only when they are taxed and they have to pay the amount. They are not understanding. I am telling you, a lot of people are doing all this e-commerce. So no equalization levy. So the moment government gets the information, they will come
Hmm.
because
I
concept
agree
is
with you.
something new.
I agree with you, sir. I agree with you. So, okay, let's proceed to the next slide. So, I have kept it, crisp and limited because otherwise people will get overdose. So, I am almost on the cusp of closure. So, I have a last slide basically. Then we'll talk about more. So, while we have talked about the digital economy as a concept, while we are aware about the taxation principle and we are dealing with those day in, day out, again, open question or work in progress is that how to fix those principles into digital economy to have a consensus, to have the same characterization of income in two different countries, so that same tax is applied, or at least the tax credit is being passed on. There is a tax neutrality. All those basic tax things are resorted to. So, couple of things which we can say food for thought, which I will leave with the audience and the participants, which we can talk about later also. So, do we need fresh tax laws, or we just need to reset or refurbish existing century-old tax principles of business connection? Because business connection was a domestic concept, whereas permanent establishment is an international concept. But both aim to tax the business income if there is a source of income in a particular jurisdiction, and both attempt to tax income attributable to a source country, not the total income of the non-resident, but only to the extent income attributable to the source country. And now we have just introduced significant economic presence. How these things will see settling the common consensus, that is work in progress, and we all will learn as we progress. But again, more thoughts are invited. Second is, source based taxation was a need of the hour, and India had been advocating this for time immemorial. But OECD and developed nations, they were always, stressing on residence based taxation. Now, through OECD two pillar, they have for the first time accepted and acknowledged that market jurisdiction should get the fair return wherever a non-resident does a business or sources an income, which is a good news. Transfer pricing rules and two pillar common regulatory body, how it will be incorporated into domestic act, how the tax treaty will be amended through the MLIs to attain uh, common tax framework. That is a work in progress, and we also need to see how our global regulatory authority, which can entertain any and every issue which is faced during the implementation of this digital economy taxation, comes into the being. So these are certain thoughts which I, believe that I leave with the audiences, participants, and they can further apply and come up with more similar thoughts, and we can talk more about these subjects. It's a very, you know, uh, important subject, and we deal about those subjects. Sanjay sir rightly mentioned that while we have been partially into digital economy, lot many people are not attempting those alternative digital economy concepts like equalization levy 2, equalization levy 1, or even if it is being done, it is being done not in the letter and spirit it was contemplated. For example, अगर सिंगापुर बेस्ड कंपनी है, लेट्स से लिंक्डइन, इंडिया में कोई कंपनी एडवर्टीजमेंट करा रही है उससे, तो इक्वलाइजेशन लेवी इंडियन कंपनी को लगाना है, वो बोलेगा इंडियन कंपनी को आप 6% खुद बियर करो, आई डोंट केयर. So Indian company is bearing that 6%, although it is applying liquidation levy, but it is not doing the way it was contemplated. Likewise, a non-resident company, let's say Amazon US, supplying some goods to Indian customers, and the threshold of 2 crore is breached, which is a very minimal thing, then ideally that Amazon has to pay 2% equalization levy to the government of India. But generally it is seen it gets passed on to the consumer. So we'll see how those things can be streamlined, or we'll see how those unilateral measures will see light of the day once two pillar approach is incorporated into domestic act as well as in the tax treaty. So these are all interconnected things and very interesting space. I try to learn and I try to share whatever experience I gained through my corporate experience. Thank you very much for patient listening, Sanjay sir, Rishabh, and all the participants. Vishal, thank you very much. Yeah.
I think, Rishabh, let us do one thing, that please keep this topic, uh, and when Dr. Girish Ahuja comes in that slot on this particular topic, you also keep it, because this has a lot of other interest. So whenever we have any webinar with Dr. Girish Ahuja on some topic, let us incorporate this topic there also, and try to have one or two more questions, case laws, research on it. So let us give this on the Voice of CA portal also, and put this in, ask Rajesh to put this in the our YouTube channel.
And Sanjay sir, with your blessing, I'm working on a digital economy taxation book also, which is
Very good.
which is I just touched upon it when I met you in person. So
Yes.
this is with audio, this publisher. I'll share more detail about it with you.
Yeah, I have a lot of interest, because I attended one of the IFA where the our Indian speaker Nupur was there. She was speaking on this, and then in IFAS, when I attended in New York, so they were also talking about the accounting of digital economy also. So this has not only taxation aspect, but it has also accounting aspects also, which are required to be seen, whether capitalization, whether it's revenue, whether we need to charge in the P&L when. So few of the things are there, which we need to also ponder upon more. So we can invite people also for all those things. So Rishabh,
Great.
over to you for rest of the proceeding.
Thank you. Sir, we were fortunate enough to have Kuldeep sir during the session. He's one of the ex-IRS. Kuldeep sir, if you are there actively with us, can you share, spend some 2 to 5 minutes and share your views on this same topic?
Thank you, Rishabh, for this opportunity. And lot is happening in the arena of international taxation as far as taxation of the digital economy is concerned. And I am very fortunate to uh, attend the seminar today and pick up some fine points from the esteemed uh, uh, lecturer today. And I'm closely following the happenings in domestic law as far as this area is concerned. And without holding much, I would like to hand over the mic to the lecturer, please. Thank you.
Thank you, sir. For the participants' wider knowledge, Kuldeep sir is one of the active scholars, and he's also an ex-IRS. Uh, so his opinions are usually are very important, and I was uh, glad to see him on the participant list. It's very fortunate for us to have him. Thank you, sir. Uh, Pushpender sir, in terms of questions, of course, there are certain admin questions that I'll take up later on. That's not a problem. We have one, if a manufacturer is selling to Amazon US, do we have to pay EL? the other way around?
No, so EL is basically for a non-resident.
Yes.
Indian government is concerned about a non-resident who does not have a whereabouts in India and selling goods or services in India, earning income from India. How to tax that income in India is what Equalization Levy 1 and Equalization 2 talks about. EL1 is for specifically advertisement, online advertisement, while Equalization 2 is a comprehensive, includes goods and services. When you are exporting goods outside of India, then there shouldn't be question of equalization levy ratio.
Yeah. I think the
May I
question was the
request
other way around.
Pushpinder ji to give his PPT because few people have posted in the chat box that they want PPT.
Sure, no problem, sir.
Yeah. So I think the question was the other way around. So I think that has already been addressed in terms of EL. Sir, again, I'll come back to my personal questions. Uh,
आपका
in terms,
खतरनाक वाला आएगा क्वेश्चन.
नहीं, sir. So in terms of this pillar two approach, uh, recently when I read one of the news articles where uh, I think it was the spokesperson of the finance ministry which said that okay, we will come out on some clarity on at least on pillar two in the main budget June or
Yeah,
July. So on those fronts, of course, whatever development will happen, we'll have one detailed session on that as well.
yeah.
But in terms of pillar one, uh, my specific question, because that is the tool which is catering to digital economy taxation, and which is distributing taxing rights to the market jurisdictions. So how do you see the development, across the globe on Amount A specifically, in terms of pillar one, in terms of developing economy supporting, because those will be the ones, or the market jurisdictions will be the ones which will be gaining more tax revenue from Mount A. Also, on the sidelines, to just put things into perspective, Singapore released their annual budget yesterday, 16th of February. And in the budget speech, there were two things on pillar one, that Singapore thinks that it will lose tax revenue in terms of pillar one. So that is why they are delaying its application or implementation. But they went ahead and introduced the pillar two rules, though from next year, January 2025. But they feel that the pillar two will have more tax revenue, at least in the short term. So, sir, how do you see it from the Indian economic perspective?
So very good question. Let me tell you first of all, it's very deep question, because now the Indian government is all set to comment on this pillar one, pillar two. Had it been a full term budget, we would have seen some of the actions at least for pillar two, because pillar one basically tries to reallocate taxing rights, and as per the OECD um, uh, description and the reports, 100 to 150 billion is what they try to reallocate somewhere in that range. And pillar 2 is basically the new thing which will generate new tax, new income, while pillar 1 is trying to reallocate the taxing rights. So tax will move around, but new tax will not come. It will move around, like a pie which is belong to a particular market jurisdiction was kept somewhere else should be reallocated. That's where all developed countries, or the countries which are already taxing on residence based, etc., they have hardly any motivation to get into that. And India already advocating source based taxation, and we see SEP as a very comprehensive concept. We don't think right now India will usher anything about pillar 1, but certainly pillar 2 is that case where Indian outbound country companies go to a low tax jurisdiction or no tax jurisdiction, where Indian government will want to keep a right of tax 15% here. So I am expecting action on pillar 2 in coming days, as opposed to pillar 1, because pillar 1 is something we already have enough in our act. If we literally read SEP, I think it already talks about the business connection, and we still need to understand the definition. It is so wide. That's my thought.
Right, sir. We'll keep one detailed session on the two pillar approach, and not just the bird's eye view or the high level one. And we'll have a small panel discussion also, because these concepts are best discussed rather than a one-way communication.
Absolutely.
So we'll have that. Uh, with that, I think we do not have anything on the board in terms of questions. Uh, Last 2 minutes for the participation participants. If they have any questions, they can put it in the chat box. So we will take them up. Otherwise, I think we will conclude in the next 2 minutes with the official vote of thanks and closing remarks by Sanjay.
And while we see any new question, let me just touch upon an interesting topic. Just it is again taking cue from Sanjay sir's inputs that people are barely using those new legislations. For example, the way we see SEP, significant economic presence, it makes a non-resident P in India if you literally go by the definition, but we hardly see a non-resident, or a company dealing with non-resident complying with those things. If we look at the SEP, it says transaction in goods, services, or property exceeding 2 crore rupees in India. It makes that particular non-resident significant economic presence in India. So, if that is the case, then we must ensure that we obtain no PE declaration and other documentary evidence from that non-resident. At least an Indian company can make sure that it is able to test the revenue inquiry or questioning. But nowadays, a lot of notices are circulated by the department to companies who are dealing in foreign transactions. So if you strictly read SEP, even exceeding 2 crore for goods, etc., it makes you SEP in India. But just because you don't have a presence in India, you can use those things. You can use the benefit of treaty. You can obtain those documents which can help to your rescue whenever there is some audit by the revenue department to your company.
Sir, thank you very much. Vishal, are you there?
Vishal, you
You
are
are.
on mute.
Vishal,
Yes,
you can.
good evening, everyone.
Yeah,
Uh,
so you can conclude the session by giving the formal vote of thanks and your closing remarks.
oh, thank you for the opportunity. So, friends, I hope everyone liked this session, and uh, by listening this session, everybody must be more curious to know about this digital economy, taxation, and many more aspects related to this topic. So, sir, we really hope to have one more session with you on this topic, as you will suggest us. So we would be looking more participants listening these kind of topic. Uh, by this, I would like to thank you each and every participant who have joined our session and be there in the in or be there who was listening the whole session. And thank you so much. And sir, thank you so much for sparing your time for us and our participants to give a real life experience of your journey to our all the participants. Thank you so
Great,
much. Thank you so much, everyone. Thank you.
great. So it was good experience. I think I just had a opportunity